Be better than the target date. Seriously, be better than the target date. Remember, there was a movie, I forget the name of it, where the guy says to Steve Carell, be better than the gap, be better than the target date. We're going to talk about that on the program along with the annual minutes scam. This one is one that's been around a long time, not necessarily a scam, that might be a little bit of a strong word for it, but just something that you get introduced to when you set up a company here in Florida and you think it's something that you must do, a fee that you must pay, and the reality is you really don't have to. So we're going to talk about that on the program as well, along with sort of our biggest topic that we'll be talking about today. So we'll start right there, and that is we are experiencing the greatest wealth transfer in all of human history. Wall Street Journal had a big article talking about this, and we want to start by giving you some of the numbers, some of the perspective on why we say it is the largest wealth transfer in all of human history. So here are the numbers, right? We've got a baby boom population, older Americans that spent decades accumulating money. And one thing that you could certainly say about that generation is that they are generally a little bit less, if you will, of a need it now, I'm going to spend money and not worry about the future. They really did focus and fixate more on that, not to overly categorize or generalize, but it certainly seems that they've done a great job, because at the end of the first quarter of this year, Americans age 70 and over had a net worth of $35 trillion. Now, if you're over 70, look, let's face it, not going to live forever, right? So over the course of the next 20 years, between now and the year 2042, about 70 trillion of wealth will transfer from one generation to another. $70 trillion. And to put this into perspective and why these numbers are just so big, you go back to the net worth of folks over age 70 at that 35 trillion number. That's equal to about 27% of all U.S. wealth. It's a 35% increase where things were just 30 years ago. To put it into even more dramatic perspective, those amount of dollars equal over 150% of the economic output of the United States as a whole in a single year. That is double the proportion of where things were just 30 years ago. Average inheritance in the year 2019, $212,854, up 45% from an inflation-adjusted $146,849 in the year 1998. As a result of that increase in wealth, just in general, you're also seeing an increase in the trend of folks not really waiting until they die, right? A lot of folks are saying, well, I don't necessarily want to wait to die because then I don't see how it gets used. I don't see how it gets spent. I can't help people now. So, as you might well also expect, there has been an increase in current gifts, a 67% increase. In fact, $75 billion in the year 2016, which is the year that we've got the data most recently, versus an inflation-adjusted $45 billion in 2010. So a 67% increase in just 6 years. So that's the backdrop. That's what's happening over the course of the next 20 odd years. About $70 trillion will transfer from one generation to the next. Okay, so stop and think about it just for a second. We're going to get into some very specific advice for the giver and the recipient here in just a second. But stop and think about that against the backdrop that you're seeing in Washington, right? A lot of conversations in Washington about wealth and wealth transfer and how we want to tax it and those kinds of conversations. So this story is certainly not lost on our politicians, and they're really viewing it as an opportunity to try and raise some tax revenue. And this, in fact, is an apolitical thought, because if we just look beyond some of the proposals that have been made by the current Biden administration, things like eliminating the step-up in basis, things like changing the estate tax exemption, things like taxing capital gains as income, all of those have to deal with sort of that wealth transfer process, particularly the elimination of the step-up in basis. We've certainly spent other shows talking about that in greater detail. We're not going to belabor that today. If you want to listen and find out more about that, just pop over to our podcast channel at Nelson Financial Planning on any of your favorite social media or podcast channels of choice. If you have trouble finding those channels, just go to our website, nelsonfinancialplanning.com, upper right-hand corner. Click on the icon that looks most familiar, and you will, in fact, find us. Speaking of our podcast, one of the accolades that we got last year was we were named one of the top 25 financial planning podcasts by the folks at FeedSpot. Lo and behold, this past week, we're actually named one of the top 20 best financial podcasts of 2021 by the folks at Welp Magazine. So very excited about that. Very excited about all of our listeners on our podcast. Anyway, so Biden administration talking about this elimination of the step-up in basis. The Trump administration, and maybe it's not quite a reflection of the administration, but more what Congress passed during his tenure. About 18 months ago, they passed the Secure Act. That eliminated the stretch IRA. That killed the stretch IRA. No longer, as a beneficiary of a retirement account, can you take that money out over the rest of your lifetime. You must, in fact, take that out over a 10-year period of time. So the notion of trying to capture and tax this $70 trillion of wealth that's going to transfer from one generation to the next over the course of the next 20 years is something that is getting a lot of attention in Washington. And the bottom line is then that perhaps you might want to start paying attention to it as well. So we'll start with the advice that we want to give the giver. There's a broad array of advice that we're going to talk about in detail for the recipient, because there's certainly some things to be thinking about in terms of taxes and structure and how the timing on all of that works. But our advice to the giver is, if you've ever been into my office, you know that there is a bumper sticker. And this bumper sticker was given to us by a long client 20 odd years ago. Every time he comes into the office, he's like, I gave that bumper sticker to your father-in-law. And that is correct. That is the story behind the bumper sticker. But the bumper sticker, so advice based upon a bumper sticker, sometimes that advice based upon a bumper sticker is pretty good. So this advice that is printed on the bumper sticker is the advice that we give to the giver side, right? You're the person with the wealth. You're the person with the money. Here's what the bumper sticker says. It says, go first class, your heirs will. Stop and think about that for just a second. Go first class, your heirs will. Sort of makes sense, right? Because here's the reality. The reality is that if you get money, no offense to the people that receive money over time or inherit money, but the reality is you didn't make that money. So you have a very different perspective and a different view on it. If you worked, if it was your blood, your sweat, your tears, your early morning, your long hours, you value that money much, much more. So don't forget the bumper sticker advice. If you are the giver, the person with the wealth, make sure you spend it. And there's no better time to spend it when we're at points like right now where the market is high, wealth numbers are very high, market numbers are. Don't forget to spend it. The advice on the bumper sticker is exactly the advice that we would give anybody if they're sitting on wealth today. Now, we're going to take a break. We come back. We're going to talk about the recipients and some of the do's and don'ts that they need to be aware of when they inherit money. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. The greatest wealth transfer in the history of the world has begun. Over the course of the next 20 years, there'll be a total of $70 trillion that will go from one generation to the next. Prior segment of the program, we were talking about our advice. If you are the giver of that, if you're with the one with the wealth, and we thought that advice to the giver, the person with the money, could be easily summed up in a bumper sticker that we have in our office and have had in our office for 20 odd years. Well, my office past 10. Before that, it was in Jack's office, given to us by a longtime client. And the bumper sticker provides words of wisdom. And it says, "Go first class, your heirs will." Translation, spend it. Now, obviously, if you are the giver, if you have money, there's a lot more structure and planning, thinking about the taxes, thinking about the timing, thinking about charitable giving, all kinds of other stuff. On this program, this segment here, we're going to focus really kind of more on the recipient. There's certainly been in our, what are we up to? Let me do the math. Probably somewhere around 1,700 episodes of Dollars and Cents over the course of the past 30 odd years. So we've certainly talked about that, what you do if you are the giver, but today we wanted to focus kind of on the recipient. Unfortunately, we don't have all 1,700 copies of those available online, but we do have, what are we up to? Probably a good 500 or so episodes of this program as our podcast. That allows us to receive accolades like the one we just got this past week, being named one of the top 20 financial planning podcasts on the World Wide Web, according to folks at Whelp Magazine. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Coming to you on a wide array of stations throughout Central Florida. We got 96.9 The Game. We got News Radio WFLA Orlando. Folks over on the Space Coast can listen to us on 92.7. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. We were fortunate enough on the program last week to have one of our associates, Kristen Cayley, join us to talk a little bit about taxes. We're going to have another one of our associates, Garrett Fields, join us this coming week to talk a little bit about how you can structure your life using a balance sheet, income statement kind of perspective that will really help you get a better perspective on where you are financially and ultimately how you want to look at your income versus your expenses. So that'll be on next week's show. On this week's show, let's get into some of the do's and don'ts, if you will, if you are a recipient, if you are on the lucky side, if you will, or the fortunate side, or whatever adjective you want to use. The reality is you just wound up with some money that you did not earn. You didn't do anything for it except by the virtue nature of how your parents did or distant relatives or whatever the case may be. You are now finding that you are about ready to receive, or maybe you have received some money via inheritance. So here are some of the do's and the don'ts if you find yourself in that position. The biggest do is that you want to do is you want to understand the tax implications of what it is that just happened. Now, there's a difference between qualified money and non-qualified money. Qualified money, generally you think of as money that's going to be fully taxable. Non-qualified money is money that generally is going to have a portion that represents after-tax dollars. Now, depending upon the type of non-qualified account we're talking about, maybe that profit is taxed as ordinary income, for example, if it's inside of an annuity, or maybe that's taxed as capital gain. This is where the whole step up in basis conversation comes into play. We're hearing a lot about that. Traditionally, the rule that has been around for decades and decades is that the basis of that investment then steps up to the value at the time that that individual passes, so that you're not stuck with the tax implications on the appreciation that occurred during that other person's life. That's one of the things that they're looking at changing. Bottom line, that's still considered a capital gain. It's still important to understand how that plays out versus if it is a purely qualified account. Nowadays, you used to be able to take that out over the course of the rest of your lifetime, so pretty attractive way in terms of being able to manage and distribute that money out over time. Now you've only got 10 years in which to take that money out. So that means you've got some planning to do, particularly important that you understand the tax nature of the money. What's the tax implications of what I just inherited? Another good thing to do, should you be the fortunate recipient of an inheritance, is it's an opportunity for you to really kind of look at where your personal financial situation looks like and ultimately use it to clean up some debt. If there's some debt out there that is maybe high interest rate credit cards or even student loans, those are the kinds of things that we would urge you to think about. Okay, maybe I'm going to use a portion of this money that I just got to help get myself in better financial position. It's not an open license to run out and get a new car. It is an opportunity that we encourage people when they inherit money to really use it to sort of reset the table financially, particularly if they're not in the greatest of financial shape. You want to then use the money to make sure that you're cleaning up those kinds of debts. Another thing that a lot of folks don't have, and this sort of continues that same conversation about improving your own financial position, is use some of that money to set up an emergency savings account. It never ceases to amaze me how many folks just don't really have a whole lot of cash in an emergency savings account for, in fact, emergencies, which happen, on a regular occasion. Then the reality is that if you inherit money, you've got a great opportunity to say, okay, I'm going to bank some of this, just put some of it in cash, put it in a savings account, and ultimately know that I now have an emergency savings account. All right, so let's say you've got kids, right? And you just inherited money. A great way, a great thing to do with that money once you've sort of cleaned up the debt, set up an emergency savings, is to think about, okay, if you've got kids, maybe this inheritance, particularly if it came from your parents, they would want nothing more, I would imagine, than to have the money go towards their grandkids, your kids, and maybe that involves setting up something like some kind of a college savings type of account, or at least earmarking some of the money for their continued education. So another good idea of something that you can do if you inherit that money. Now, here's the thing. If you inherit money on an after-tax basis, that's a real opportunity to supplement your overall retirement picture, because money that is after tax, as you use it, it's subject to capital gains rates, and ultimately those capital gains rates are much, much lower than ordinary income rates, which would apply if you're taking money out of a retirement account. And then lastly, on the do side, do learn to say no, okay? A lot of folks know when things transition from one generation to the other, it's called the obituary page. There are many out there who read it and then subsequently target the people that ultimately inherited the money. So learn to say no when it comes to that. We've got a few don'ts that we're going to hit when we come back. So we're going to take a break, and then we got a handful of don'ts if you are inheriting money. So we'll slide to the break, and then when we return, we'll wrap that up and then shift gears to the conversation about the annual minutes kind of scammy thing that is going on out there today whenever you set up a corporation in the state of Florida. All that and more coming up on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about the largest wealth transfer in human history, $70 trillion going from one generation to the next over the course of the next 20 years. We've talked on the program about what our advice is to the giver. Go first class, your heirs will. That's pretty succinctly summed up. And some of the do's in the last segment of what recipients should be doing should they find themselves on the receiving end of an inheritance. We got 3 or 4 don'ts that we want to share with the recipients as well. And then we'll shift gears in this segment and talk a little bit about that annual meeting minutes kind of scammy kind of thing that goes on when you file a company. So on to the don'ts real quick. If you are a recipient, these are some things that you don't want to do when it comes to inheritance. Don't Spend the money without thinking about the consequences, because there could be some tax consequence. There also could be some long-term impact on your financial picture. Next up, I guess, on that list of don'ts is don't run out and quit your job. The reality is that, yes, you may have inherited a good chunk of money. Average inheritance is around $225,000 these days. But the reality is that your $225,000 won't last an infinite period of time. If you're working a normal job, $60,000 a year or something like that, the reality is you're looking at about 3 years or so, and then it's done. So don't just run out and quit your job. As we were saying in the do's category of what you should be doing in the last segment, it's important to kind of really take that and improve your financial shape, right? Pay off some credit cards, set up an emergency savings, and use it as an opportunity to perhaps get your finances in great shape. Don't just run out and quit your job, because the reality is it may not, it's probably not, I mean, it seems like a lot when you get it, but at the end of the day, it's not necessarily going to be as much or last as long as you think, particularly if you start taking large chunks of money out. So bottom line, don't go crazy with it. And then lastly, what we would say to anybody, whether you inherited money, whether you made money, or whether it's money just sitting there, don't keep it all in cash. That's just not going to work. It's not going to work for a variety of reasons. First of all, there's always taxes. Second of all, there's always inflation. And inflation obviously creeping in a little bit more this year than what it has in the past. The reality is, if you keep it in cash, then there won't be hardly anything for a return. Particularly right now, it's nothing for a return. And the reality is, ultimately, you will lose. You think you're playing safe, but the reality is you are, in fact, losing money after the impact of taxes and inflation. So you've got to look at, anytime you inherit money, that you've got to look at it from the perspective, okay, how do I get this invested? What's the right balance to invest? What's the right balance to save? What's the right balance to pay off? All of those kinds of things. Those are the things that you want to be thinking of should you be on the receiving end of an inheritance. Speaking of receiving end of things, was on the receiving end of a little letter that looks very, very, very official. And the reality is that if you've ever set up, and we're going to hold it up for the camera for our YouTube audience, if you've ever created a corporate entity, and there's a lot of reasons why you might have done that. Maybe that's to hold a piece of real estate, maybe that's to hold an asset, or just anything that has value or creates income. There is a basis for that says if you set up a corporate entity, whether that's a corporation or a limited liability company, then ultimately you create a layer of protection because that asset is not in your personal name. So if something goes wrong, some accident, whatever the case may be, someone gets injured at the location of this asset or on the premises of this asset, then you at least have some layer of protection against them being able to come after you personally. But in order to get that layer of protection, there's certain things that you have to do. You have to respect, if you will, the corporate form of what you just established. Well, I happen to set up an LLC recently with the state of Florida as well, like many people do from time to time. And when you do that, it's a matter of public record, right? So if you look up Nelson Financial Planning on SunBiz, right, which is the state of Florida's website for corporations and LLCs, you'll find that there it is, Nelson Financial Planning. Owner is Joel Garris, and Joel's address is the office address, 423 Country Club Drive. All of that is all right there. The date of incorporation, all of that right there for the world to see. So it's all public information. It's all public information that ultimately there are folks out there that use that information to ultimately approach you with things like this. So there is, as there is with anything, a learning curve associated with establishing a business. Every company has certain requirements you must follow, right? You've got to do an annual report, you've got to pay an annual fee, you've got to register an agent for service of process, you've got to hold an annual meeting. Those are some of the baseline statutory requirements when you set up a company in order to make sure that the protection afforded that corporate entity is in fact going to come to you. Because if you don't do what you're supposed to do with the company, then it can be disregarded. So once you have the information, it's relatively pretty straightforward. But with anything in life, there's a little bit of a learning curve. So one of the things that folks sort of have a learning curve on when they set up a company is, this notion of annual minutes. So annual minutes is something that you've got to do, and an annual meeting is something you've got to do each and every year. But it basically just says, okay, who's the director, who's the officers, and what big actions were taken this past year, and okay, yeah, we approve them, and that's all there is to it. Well, the annual meetings, I guess, scam, and we're going to refer to it as a scam, because anything that is presented to look like a government agency, but it's really not, that to me, in my mind, kind of starts to border the scam thing. So it looks pretty official. Here it is again for the folks looking at it on our YouTube channel. And it says on the outside, corporations filing service, open immediately 2021 annual minutes statement, business mail, time sensitive, and then it lists the name of the company. Annual minutes form 2021. You open it up and it continues on even further. It says it's the compliance division. Oh, wait a minute. Now I really got to pay attention, because this has to deal with compliance. And if you don't comply with things, bad things happen. And then underneath that, the compliance division, it has the document number for the company that I just set up. The name of the company was Amelia Grace, LLC. That's got a long story behind it, which we don't have enough time on the podcast for that. But the document number is there, the date that the business was incorporated. We just did this past month, June 14th. And so it's from the compliance division, right? And it then quotes Florida. It's out of Tallahassee too. So again, Tallahassee would be where you file all this stuff. Then it quotes a couple of different, see, we'll hold it up for the YouTube folks, quotes a couple of different statutes in Florida, Florida Business Corporations Act, Chapter 607.1601, paragraph 1. And then at corporate records, it quotes. Okay, so it looks pretty official, right? And it seems like you should be going along with this. And then it has, tell us all this information, shareholders, directors, officers. And for a mere fee of $155, they will take care of that. Here's where it gets a little deceiving. There's the fine print. And here's the fine print. Corporations Filing Service, which is the name of this company, is not a government agency and does not have or contract with any government agency to provide this service, nor does it fulfill the state's Florida's annual report filing requirement. Well, okay, so what am I getting for $155? Well, it's not a government agency. There's nothing special about doing the annual minutes. You have a meeting, you record the date, you record who was there, you reappoint the officers, you approve major transactions. I mean, if you just simply Google annual meetings, I did it this morning. It's like 3.7 million searches or 3.7 million pages that will come up that give you options to do this for free. So, as with anything, there is certainly a learning curve when you set up a company. There's certainly a learning curve when you do that. But take an opportunity to spend some time and don't fall victim to this silly stuff that says for $155 a year, we'll take all of your information, drop it in to a mail merge, send you out a document, and poof, there you go. Thanks for the $155. Take a minute, as with anything in life, right? This is advice that applies universally. Take a minute, climb the learning curve, learn a little bit about it, and I assure you, you can do this one yourself. So don't be intimidated by that official compliance letter that you might get when you set up a company in the state of Florida. We're going to take a break. When we return, we're going to talk about why you may want to do better than the target. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Be better than the target date. Seriously, be better than the target date. One size, when it comes to plotting your investment, doesn't fit all. And a lot of employer plans really push that as a sort of a, this is fine for everybody. And if you're a listener to the regular listeners to this program, you know that we constantly talk about how unique each person's individual situation is, what their health conditions are, what they expect out of retirement, what their monthly expenses look like, what their tax, it's all unique. There's no duplication out there, but yet we've got an entire industry that is predicated upon one size fits all. Just put in your date of birth and it will magically match it up. And you know, over the course of time, we've certainly talked about target date funds before and how cookie cutter they really are, because at the heart of them, they were designed to reduce liability to the employer and the provider. Well, despite these conversations over the course of the years, we find over $3 trillion now invested in target date funds. So we thought in this segment of the program it would be good to sort of recap what they are and what they aren't, and why you should strive to be better than the target date. So here's where they are, right? So a target date fund is basically a basket of other funds that ultimately looks to try and determine a particular allocation of money, percentage of the portfolio that's to stocks, percent of the portfolio that's to bonds, percent of the portfolio that is to cash. And as you might well imagine, the difference between stocks, bonds, cash is cash safest but lowest return, stocks higher return, higher potential for volatility. And so ultimately a 2020 target date would assume, hey, that's the target date for retirement, so that one's going to be heavier on the cash and bond side of things versus say like a 2040 fund, hey, I still got 20 years to go. That fund is then going to have a much higher proportion on the stock side. So the closer you are to the year, then the more conservative that fund will become. The further the year out is, then the more stock oriented or growth oriented that fund is going to be. So that's sort of how they're designed to help with looking at the year that is put on the particular fund as a guidepost for what it is in terms of the types of investments that it's going to hold. But here's the fine print, and here's what you need to know, and here's why we would say to you, hey, be better than the target date. First and foremost, there's no really universal standard. If you look at a target date fund from one investment management company versus another, there can often be swings of 15, 20, 25% in terms of what the underlying mix is versus stocks versus bonds. So there's no universal standard. So what you're getting with one company's 2030 fund may be completely different than the mix that you're getting with another company's 2030 fund. And why is that? Well, why is that is because these funds are, the underlying investment allocation in these funds is all a function of the judgment of the particular money manager. Well, as you might well imagine, different investment managers are going to have different judgments, and so consequently one fund can be quite different than the other. So no real universal standard on exactly what these funds are going to look like. The other limitation to them is that they are designed to get you there, but certainly not through. So if you're planning on retiring in 2025, right, and you've got picked out the target date 2025, well, what happens when you get there? You're stuck with an investment that is very heavy on the bond side of things, but if you're retiring at say 65, you got another 20, 25 years to go, so that may not really work for you to generate out income and deal with the impact of inflation and deal with the impact of taxes. So what happens when you pick the particular date and you pick the date as your retirement date, then it winds up really kind of getting you to that point, but it certainly doesn't really work for what happens after you reach that particular year and ultimately retire. That's one of the biggest reasons why we talk about potentially rolling 401ks over to IRAs. Those are tax-free transactions that ultimately give you the opportunity to really craft an investment allocation that is unique to yourself and ultimately reflects the level of income that you want, what your health issues may be, what your life expectancy may be, and similarly, how much you want to leave to the next generation. We talked a lot about that earlier in the program. The third thing to sort of consider, if you will, in the fine print is, and this is where we get a little jaded in terms of the history of the financial services industry. The financial services industry is very marketing driven. We've been doing this for well over 20 years, and we see these periods of time where the industry gravitates to stuff that it can more easily market. So understand sort of when these target date funds started to really come into vogue, and that was right after the financial crisis of 2008, 2009, when a lot of employees saw their balances go down, and as is human nature, looking for somebody to blame, the blame started shifting more to the employer and the 401k provider or the retirement plan provider, and saying, okay, well, wait a minute, how come you didn't do something that allowed us to provide better protection in the event of a market decline? And so the industry simply responds by saying, well, that's fine, we can figure this out because we'll get our marketing folks on it, and ultimately create something that is really more of a default option that ultimately spins itself much more conservatively much earlier than it really should. So if you take a moment and step back and understand sort of where these funds came from, when they became popular, they really were intended to be a cookie cutter option that ultimately eliminates any potential liability from the employer and from the plan provider. If you know that about the history of how these funds really came about, then you may want to really second guess why you're using these funds in the first place, because they really were intended to do that. Put your birth date in, and ultimately it'll get so conservative by the time you get to retirement that no one will come back to us and blame us. So bottom line, be better than the target date. Be better than the default option. Take a moment and really look at the other investment options that are available to you in your plan, and really spend some time trying to craft an investment allocation that is best for you. If you have trouble with that, you should be able to reach out to your current financial advisor. If you don't have a current one, you can certainly reach out to our firm, Nelson Financial Planning, to help you craft that in a little bit more detail. So bottom line, be better than the target date. We'll wrap it on up and get on out of here. Have a great rest of your Sunday. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning.